Okay, let's work on a few problems before we end the chapter. Let's say the company's bonds payable carry a stated interest rate of 5%, market interest rate is 7%, and what would be the answer to this question? Market interest rate is higher than the company's interest rate that they're offering. So the result of this bond issuance would be market interest rate is higher, company's interest rate is lower. So company is at an advantage or disadvantage? If it's the same, it will be issuing at the par value. If it's different and market interest rate is higher, meaning bondholder, if you are a bondholder, you're expecting more than what the company is offering. So if that, in this case, if you're borrowing money to the company, you'll be borrowing more money to them or less money to them? It will be less. So in this case, it will be a discount. Okay, market interest rate, if it's higher, that basically represents the creditor's expectation. They're expecting more from the company, the interest rate. The company is giving less, and basically it's a discount. Okay, if the case flips, if market interest rate is 5%, stated interest rate is 7%, then that means company is offering higher interest rate compared to what market is anticipating. So in that case, it will be a premium. Okay, but this one here is a discount. If it's the same, then there will be issuing exactly at the face value. So if it was $100,000, it will be at $100,000. A discount means that the company is only able to borrow less money than $100,000. Okay. Okay, next one here. Let's say, well, the problem didn't tell you the maturity value. So if it's 500,000, then it's 500,000. Okay. So your Michael's trial balance shows 200,000 face value. This is the maturity value, the par value for the bond, and it tells you with a discount balance of $2,000. Let's say the bond matures in 10 years. How will the bonds be presented on balance sheets? So which one looks like the answer here? A? Any other answers? If A's the answer, what's wrong with B? There's got to be something wrong with B, right? Discount is actually the part that's correct. If you keep on reading the problem. Contra account, it is a contra account because it has opposite direction, right? Adjunct account is the one that has the same direction. So the problem for B actually is the term current liability. Remember, this entire chapter is about long-term liability, and discount on bonds payable is an account that stays there as long as the bonds payable's lifetime. So both of these accounts are actually long-term liability accounts. So the problem for B is that the discount on bonds payable is still listed under long-term liability section. If it's a short-term liability, that account completely would disappear after a year, but that would not be the case for bonds payable accounts. Okay, all of the bonds categories, basically, they're typically longer than 3 years or 5 years or even more than that. Okay, so both of the accounts are long-term accounts. Now, bonds payable, 200,000 will be listed as a long-term liability only. This part for C, it's missing the discount on bonds payable. Okay, D, bonds payable, 200,000 will be listed as a long-term, $2,000 will be listed as current. So this part again is the current part that's wrong. Okay, so the answer is A. It will be bonds payable at a net amount subtract $2,000 of discount. Last question here. Let's say this company has $700,000 of bonds payable, 20 years lifetime outstanding. We need to issue the bond. These bonds had a discount of $56,000 at issuance. So it tells you the discount amount is $56,000 at the time point when they issue the bond. That basically is the amount that they did not get while they issued this $700,000 of bond. And this happened 10 years ago. So if the company uses straight line amortization method, that basically is the method that we have been using in class, then the carrying amount of these bonds payable after 10 years, what's the carrying amount of the bond? So for this problem, at the time point when the company issued the bond, what is the carrying amount at that time? You know, face value is $700,000. You know, the discount. So at that time, the carrying amount would be $700,000 subtract the $56,000, right? So what is this amount here? It would be $644,000. So this is the carrying amount at the time of issuance. So what we want to know now is after 10 years of paying interest, amortizing discounts, what is the dollar amount 10 years later? The carrying amount of the bond 10 years later. So first of all, what will be the direction? Is the carrying amount gradually increasing or decreasing? Not sure. So the carrying amount at the time point is here. It was issued at a discount. Gradually speaking, it will increase to a point that matches with this. Okay, if it's a premium, it will be a dollar amount, something like $750,000 as an example. Gradually speaking, carrying amount for premium will be reducing to a point that reaches carrying amount, the face value of the bond. So if it's a discount case, gradually carrying amount will increase. So you know for sure 10 years later it will be a dollar amount higher than $644,000. But now we need to know what is exactly the dollar amount. So the discount part here, remember this part we gradually amortize it along the years. So $56,000, if we divide it by the lifetime 20 years of the bond, that will give you a yearly amortization. Then you use this times 10 years. That will give you over 10 years what you increase to the bond's carrying amount. Okay, so first step, calculate what was the original carrying amount, $644,000. Then you calculate on a yearly basis what is the part of the discount that you spread, that you add to the bond's value. So that will be $2,800, meaning every single year, $2,800 of discount will be reduced. So carrying amount will be gradually increasing to a point that gets closer to the face value of the bond. So after 10 years, bonds face value will be bonds carrying amount will increase to additional $28,000 more. You just add that to the original carrying amount. The reason why this is because remember every half a year we journalize interest expense entry. So every half a year we gradually reduce this discount on bonds payable while we journalize the interest entry. Remember we pay cash interest and then a little bit of discount on bonds payable will be amortized every half a year. So this part here tells you every single year, meaning if we times twice of what we journalize every half a year, that will look like this. $2,800 will be reduced from discount on bonds payable account, and at the same time this deduction increases bonds payable by $2,800. Okay, so little by little bonds carrying amount will gradually increase, and after 10 years it will reach this point. After another 10 years it would reach the face value, $700,000. Okay, so this part here, if you add another $28,000, that basically will give you $700,000 because the lifetime of a bond is 20 years. So this is the part that increases 10 years, and another 10 years you just add another $28,000 and that will give you the face value. That's the time when the bond matures. Okay, questions? Okay, I'm going to move on to the following chapter on equity. The following two chapters